Greetings, Jonathan Camarda, Chief Investment Officer. Hopefully you guys are all doing well out there as we end a tumultuous up and down roller coaster quarter. First, we had to rip to the upside in July off the mid-June lows, right into Jackson Hole, where the market precipitously dropped with a thud, until today here, 9:30 as I record this. Now, the good news is as you look across your statements from a macro level, over the last month and a half, where the market has really seen a hard hit after a nice July, you'll see that clients as a whole, you have lost a lot less than what the markets have, as we have been cautiously deployed and pretty defensively minded. Now, as you look for the quarter as well, the market had a great upside to July, but many of you, as you look across on a relative basis versus the S&P and as such, looking good versus that as well when you get your quarterly results. So where do we see things now? Well, before going to the quarter ahead, let's just kind of do a quarter and year-to-date review of where have been the pockets of weakness and strength, as we're trying to do every 3 months, just kind of give you some perspective. Surprisingly, this last quarter, consumer discretionary, think travel stocks and some of the FANG stocks, actually, which did very well in July, fell in August, but actually held the lead spot for the best performer this quarter. Of course, energy not far behind, as all year energy has been the really only shining light across all sectors. Real estate had the worst quarter, makes sense, right, with where you've seen mortgage rates +6 now and as such, and going up. So therefore, you've seen materials, real estate, and then, of course, technologies as well, which have been hit towards the latter portion of the quarter. And for the entire year, it's been technology and consumer discretionaries, which led this quarter, but for the year, still woefully down near the bottom of the list, and real estate not far behind as well. Your defensives have held up, your consumer staples, utilities, of course, still not a great year as far as positivity, but relatively held up well, with your energy, of course, positive nicely still for the year with all the ups and downs that it's had. Now, when you look across, right now is market sentiment, manufacturing, housing starts, pretty much on the down move, right? And you look at, we talked over the last really several months of inventory stocking up. You saw that even with Nike not too long ago here on their earnings over the last couple of days. And again, cross-currency effects and certainly inventory pileups that are not attractive either. So now when we look across to the fixed income markets, as bonds have been no solace this year, you've heard a lot of talk maybe out there of the 60-40 strategy, right? Where it used to be 60% stocks, 40% bonds, has not worked. Thankfully for you, we have delineated from that mindset for a while, as alternative assets are a huge piece of what we look to do to integrate, and certainly has helped because they just don't move in the same directions as stocks and fixed income have this year, which has been the same, down, right? If you look across the sectors of the bond market, what's held up well this quarter, actually, believe it or not, high yield held up, but not for the year. It's been basically the shorter term duration treasuries, 1 to 3 years, which have held up, with the 10-year and the mid duration. Are you sitting down? I am. Mid-teens. Down, and the 20-year treasury, drum roll please, the award goes to trying to keep up with the downside of the NASDAQ. The 20-year treasury down in that 28, 29% range. Really, you can believe it. So again, we've had very little to no exposure over any significant periods of time that long out on the curve, except for quick shots in the spring and as such, and here and there sprinkled in. The strongest, obviously, asset class among energy has been the U.S. dollar, which many of you have participated in as well. And, of course, long interest rates, short treasuries, have done well. Now, you'll notice across strategies, again, that you'll see sprinkled in there some opportunities to short using inverse ETFs. Again, most advisors just don't touch these. And, again, we are CFAs and as such here without getting to the alphabet soup. Again, bringing value to you on down markets by hedging downside has not worked with just equities and fixed income. So again, when you look at your statements and you look at some of the short positions, we are nimble, and sometimes we do exit those positions, even if they're still going up, because they do recalibrate, like options, if you will. So that's why you may see that, but nonetheless have added value over multiple time periods that we've been in them. Again, really just to clog the leak, proverbially speaking. Again, these are not positions where we're using them as pure alpha positions, like, where you look at buying Apple stock in an up market, but think of them more as radiator stop leak or caulk in the bath tile to really just stop the leak from the long positions. What they call in the business an overlay strategy, which in and of itself is not meant to create alpha on the entire amount, but to, again, hedge some of the outlier, what they call negative skew events, which in English means losing a lot in your portfolio. And as you look over the last month, that has not happened for many of you, out there because of that. So as we look to Q4 and put what's done well and not done well year to date and quarter to date, we remain prudently defensive. Again, we could easily have a rip to the upside here, a relief rally as the market is oversold. Some more of your nimble strategies like global macro, tactical, and your Velociraptor strategies, which more are outlier strategies, will take advantage of some of those short-term rips. To a lesser extent, sector momentum, and to an even lesser, to not much of an extent, your macro momentum, active capital preservation, and then certainly opportunistic growth in income, dividend payers, which are generally more longer-term based. So again, talk to your PWA on the makeup of your sleeves to determine exactly how nimble and how those allocations are calibrated on a weekly, monthly basis. With that being said, we remain very cautious. Generally, a seasonally strong time of year ends up being late October through the rest of the year. The Santa Claus rally and confluence with an election, potentially. But as we've been calling here for a while, we do see Jerry and the Feds. Can we kick up the band in the back? Jerry and the Feds going with another 75 basis points. Nobody wants too much humor, but we must have some levity as we're relatively holding up pretty well, people. And at the same time, again, hopefully many of you were spared some of the hard effects of the hurricane, and if not, Godspeed to you. And if there's anything we can do to accommodate in getting some of the information to you, or if you've had any loss of internet, etc., certainly call us up, as we're here to help, and we are sensitive to that. As we say a prayer for our brethren, we do have clients in Southwest Florida. It's very sobering, I must say, as well. And I think on that note, I'll wrap it up. As health comes before wealth, but wealth's right there. And we just appreciate that you put us in charge of making sure that we keep that W a capital W. Again, appreciate your time, your patience, most importantly, your trust. Stay frosty. Enjoy your football weekend or however you guys relax out there, and gals. And until next time, Jonathan Camarda signing off.